taking time today to join us for a panel. We're going to be speaking about how to recover your digital assets from FTX. I want to start off with a warm welcome to our panelists. We've got Daniel Hinton from sFOX, leading operations. We have Jack, head of product at sFOX. John Menino, our chief compliance officer. We have also Matthew Dudon, principal at Dundon Advisors, who's going to be leading us in the beginning, chatting about what's been going on with FTX. I will let Matthew take over and just discuss what's been going on in the past week or so.
Hello, everyone. I appreciate the chance to be with you, talk about what we know about FTX, what we don't know, and maybe some informed guesses we can make. Kind of three large buckets of knowledge. First, it's important for me to note that we have many clients in the cryptocurrency space, and my comments today are strictly my own. They're not to be attributed to my firm or to my clients or any of the firm's clients in this or any other case. We have been advising stakeholders in all of the crypto bankruptcies that have occurred in the past couple of years. We advised the creditor committee and now the liquidating trust in cred. We are managing a very large, complex set of claims in Celsius on behalf of institutional clients, and we advise the ad hoc committee of equity interest holders in the Voyager case. We have not been engaged by anyone in FTX, so once again, just my own opinion. When any financial institution commences bankruptcy, it commences bankruptcy typically because of crisis of confidence of lenders and depositors. And remember, depositors are really just a form of lender to the company, and deposits are liabilities of a company, not an asset. And so the failures of the large cryptocurrency concerns, including FTX, have in that sense not been exotic. They've been something that is very familiar to people who understand the capital structures of financial services companies and understand how they fail. The market's loss of confidence in FTX, right, is something that we've seen many times. Rumors have a way of becoming true. FTX may or may not have had significant fraudulent or misstated elements, but if you require the confidence and trust of lenders, once that's gone, you're out of business no matter what you did, right? And that is certainly something that we've seen in the crypto bankruptcies. There's been a continuum of, let's say incompetence, misconduct, or just wrong place, wrong time. And for FTX, we'll see sort of how those ingredients end up piling up relative to one another. What's important for people, one thing that's very interesting in all the crypto bankruptcies to date is that account holders were absent from the initial phases of the bankruptcy. And that is something I think that is probably not going to be the case for FTX. There are groups of account holders that are organizing, and some of you may consider organizing with one another, and some of the people you're seeing on screen here to be part of that. And that's very important because significant decisions can be made very early in the bankruptcy that can entrench certain good and bad things. And the good things are good, the bad things, they can be hard to undo. The biggest thing that I am concerned about being hard to undo is financing. So because FTX may have seen its stock of Bitcoin and Ether and stablecoin whittled significantly down, it may need a large upfront financing facility from a hedge fund or a consortium of private financiers in a way that we did not see in cred, Voyager, or Celsius. Our challenge there is that the terms, there'll be proposed terms for such financing, and while you get another crack at whether or not those terms are fair, they stick for the money that's lent between the first hearing and the second hearing. So let's take a world where FTX were to come out tonight or tomorrow morning and say, we're borrowing $75 million from hedge fund X or $100 million from hedge fund Y as a DIP loan, and we're going to take the first 40 million of it immediately. Whatever the terms on that first 40 million are, when there's an official committee organized and other things that we can talk about a little later, if you come back and say, I don't like these terms, you're stuck with them. You have two options: live with them, or three options actually. Persuade the lender to modify the terms to stay in business, keep the loan outstanding, accept the terms, or pay the person back. So, and it might be hard to pay the person back at better terms. So that loan on the first day of the bankruptcy could end up sort of having a character of permanence that could end up being very expensive depending on what collateral it chooses to take in the capital structure. So that is something that is very important and people need to be mindful of and will be a little different. Secondly, there are some things that in many bankruptcies are routine, but here are going to be very non-routine, which is permission to pay foreign creditors and how cash, and in this case, cryptocurrency, is supposed to be managed, what accounts it stays in, and so forth. Because we had this post-bankruptcy filing hack or backdoor that saw hundreds of millions of dollars flow out, it's extraordinarily important that be handled correctly. And you'll notice between the new chief executive officer, the chief restructuring officer, and the 5 directors that were brought in yesterday, none of these people is a cryptocurrency expert. We know Judge Farnham, Matt Doheny is actually a friend of mine. So, two out of the 5 people, very good people, trustworthy, not a bad choice, but not cryptocurrency experts. Alvarez and Marsal is a financial advisor to Celsius. So by now they probably know a thing or two. The Sullivan and Cromwell firm is not a firm that has a lot of representations in Silicon Valley with people who are active in blockchain. They're really a New York white shoe finance firm, and we're brought in primarily because the FTX general counsel was an alumnus of that firm, and it really is sort of from a DC kind of lobbyist financial regulator provenance as opposed to a technology lawyer provenance. So this means that you cannot be certain that the arrangements that are going to be proposed for ongoing security are going to be satisfactory. I hope they will be. Certainly, it's a bad sign if they're not, but this is something where holders certainly need to step up on day one and make sure those arrangements are reasonably satisfactory. Obviously, protection of books and records becomes very important. A company that has limited records and informal records and keeps things in the cloud, it's easy for things to go away, right? They were not able to walk in and say, we've secured one office in Manhattan and it's got physical files and we're good. We know where all the bodies are buried. So things around getting records are critical. As I mentioned, the foreign vendor payment stuff, that's in the boilerplate of a lot of first day bankruptcies. Here it would be massively inappropriate. This is primarily a foreign bankruptcy. Even the U.S. operations were primarily run, by executives from overseas, and a lot has to be thought about there. And similarly, the extent to which this Delaware bankruptcy in front of Judge Dorsey is going to stay in, the extent to which it's going to have control over foreign insolvency proceedings, which have already begun. And so people need to be listening very carefully. Ideally, what you'd want is one central controlling court that sort of has primary authority to steer a process. So, for example, in the Lehman Brothers bankruptcy, the Southern District of New York Bankruptcy Court had that coordinating role, but did things in comedy with insolvency venues all around the world. So that's all stuff to look for. It's important for each ad hoc group to have qualified bankruptcy attorney to stand up for it at that first day hearing. And let's talk about timing. We have been promised additional pleadings. My guess is that the first day hearings, which are going to be more like the 10th day of the case, will be Friday at the earliest, more likely Monday or Tuesday of next week. And I don't know if Judge Dorsey, and this is a big enough case that I think he'll stick around. Dorsey is a skilled bankruptcy judge. We've been in front of him many times in big cases. He had handled and still handles the cred case and has done so with I would say a reasonable degree of aplomb. So you've got a good judge, but it's important for groups to have good lawyers. That is something where everyone is hearing about organization, but to the extent that, it doesn't hurt to have 2 or 3 sets of people at those first day hearings, and you can't count on other people being there or being effective. So I would certainly encourage the people here, to the extent they're working with the other people here on the screen as a locus of organization, to make that move. And the nice part is there's no commitment, right? There will be, over the next few weeks, an official committee of unsecured creditors will be formed. There'll be probably 1 or 2 creditor committees abroad. So stepping into this on the first day doesn't oblige you to say, hey, I'm going to keep doing this. And
insightful. And I think everyone on here is learning a lot in regards to, anybody with the, that has been, has had this happen to them, that has funds stuck at FTX, and you're explaining this 3-page application. Is there anything that you would recommend that they can do today, or how your firm might be able to help organize account holders through this process? You've mentioned there's this 3-page application, that there's this option to hop on calls weekly, but I'm curious if there's any step-by-step, what should they be doing first or thinking about first?
So there's one thing. This is a nice part. Oftentimes bankruptcy breaks down in kind of discrete chunks of things by time. Right now, what is important is to be organized for the first day hearings, which, as I said, will probably be Friday or Monday. And that just needs, 3 or more people. Ideally, it would be somebody with, in the aggregate, at least $5 or $10 million in the account. So if you have 50 people with 5 or 10 million, that's great. If you have 1 institution with a lot, we are certainly talking to a number of very qualified law firms and other folks who are eager to do that. So once again, I suppose anybody who is willing to be part of that, and that basically is just willing to be on a couple of phone calls over the next 5 days, willing to have your name disclosed potentially, but not your contact information. The courts have been very willing to permit some degree of anonymization and identity protection, but you also can't come into a U.S. court anonymously and saying, hey, if you want to say, hey, I'm here and I want something, unfortunately, you have to kind of say who you are. So the lawyer would file just a statement, which would have a list of, here's the 40 people and here's what they had on account, or they had not less than this amount. And that's the basis of what we call standing. And then to be signed, have 1 phone call where, based on what gets filed, can formulate what the objections might be or the request for improvement. And oftentimes in bankruptcy, and I'll leave this as the last comment. Oftentimes the bankruptcy professionals, people like me, the bankers and the lawyers, are kind of telling creditors what to do. Here, because there's so much expertise among creditors, especially the people who volunteer, I guarantee you that I see now 72 people on this call. I probably know less about FTX than all but 2 or 3 people, right? Even though we've been in this space for a couple of years now, there's tremendous expertise that flows back, and the people who are smart about this process are harvesting that expertise, so we can have conversations about what is being done to protect assets, what is being done to avoid things being done, and hold that. So we're eager to do that. That's very exciting. And so I guess we would also say that we should have, if we want to come out, I think we have the email list for everybody who's on here. There's 1 people who want to volunteer for that very short-term exercise, and then 2 folks who are interested in getting the application to be on the official committee, and that is a very long-term commitment that will be very exciting for some people, but you gotta have the time for it.
Definitely insightful, super helpful. I want to transition things over to our Chief Compliance Officer, John Menino, and just to talk a little bit more on, the recent events and what your thoughts are on if this will accelerate or slow down regulation in the crypto markets. What are you seeing in the recent days?
Yeah, so thanks, Sarah. I think, if we take a step back for a second here, and we just sort of look at all the activity that was going on prior to last week, there definitely was this push towards more of a tighter regulatory framework. And that was really sort of across the globe, not just solely in the US, but we're seeing that in the UK and throughout Europe and in Asia. So all of that was already well underway. I think what we're now just sort of seeing is an acceleration of what was already kind of, in the works. I think, when we look at sort of, some of the stuff in the congressional aspect of things, even crypto regulation was, for better or for worse, was really sort of a very bipartisan, activity, in the sense that, I think that there was a uniform consensus, both, in the US, amongst Democrats and Republicans, that this was something was sort of needed, right? And so, what's happening right now is, Maxine, from a congressional perspective, Maxine Waters, who's sort of like the chair of the House Financial Services Committee, she's beginning like congressional investigation. She's thinking about congressional investigations about this, wanting to bring, SBF to actually potentially even testify in front of Congress. And so that aspect of is happening. And, on the other side of that is, Republican Representative Patrick McHenry, who is the current, GOP ranking committee member, who, it looks as if the House is actually going to, flip to the Republican side, who would actually ultimately then become the chairman of this. And even he has sort of said in this space, there needs to be sort of, more investigation sort of around this, right? So it's very, very clear from a congressional perspective, we're seeing that. We're seeing it from the White House. The press secretary has been very, very clear that the Biden administration is monitoring this very, very closely and looking for oversight. They want to make sure that, we have proper oversight, to protect everyday Americans, is sort of some of their quotes. And then the last thing I would just sort of say is, even, between the SEC and the CFTC, both sides of those, both of those organizations, and there's been a lot of push and pull between the two of them, obviously around kind of who should have oversight, with this. SEC Chairman Kristen Johnson, has been, very, very, very vocal about this, and I think a very, very, interesting kind of comment from her is that, this is, a prime example of, never letting a good crisis go to waste, right? And in the sense of, these types of things, spur activity within the government. The Lehman collapse really sort of spurred the Dodd-Frank Act. Enron collapse really sort of spurred, Sarbanes-Oxley, those types of things. And then, on the flip side, the CFTC is kind of, trying to sort of, show a little bit of clout here by basically saying, well, if you look at FTX US, which was governed by the CFTC, that's not part of this bankruptcy proceeding. Our rules, our regulations are actually working to protect customers. And so there's really sort of like this really, really big push, and the head of the CFTC basically just is like, his final quote on this was like, we don't have the luxury of time anymore on this. So all these things I think were happening, but is going to be very, very accelerated, as 2022 winds down and as we move into a new congressional leadership in 2023.
Certainly. And I think it might be interesting for the audience also. And I do want to comment, we're receiving some different questions, which we will be addressing towards the later end of this hour session. So keep the questions coming. I see some great ones and I'll get to those. I wanted to step back a second and John, if you can answer a little bit more on what differentiates a normal exchange from a trust company. This is something that I think a lot of people are seeing the news. They're afraid of keeping their assets on a centralized exchange. Do you have anything there you might want to share on those differences?
Yeah, sure. So I think that this is a really important aspect of things. And I think, one of the really important things that differentiates sFOX from sort of, FTX and all these other kind of companies, right, is just that, we provide, fantastic liquidity to customers, right? We manage an order book of like 30 plus exchanges, 80 across, 80 plus OTC markets. This enables us to not have this, reliability on one exchange per se. And I think, the other kind of critical component of this is our Wyoming trust license. Trust companies have been around for a very long time, and many US states have them, Wyoming, New York, South Dakota, et cetera. Those are key states that have, important trust licenses. We were very, very fortunate. We became the very first digital asset native only company to have a trust license within the state of Wyoming. And why this is really sort of important, right, is just that this, is a regulated entity by the Division of Banking, in these states. And these types of things, are viewed with a banking lens, right? And so we're taking a banking lens and putting it into, a digital asset native environment, and which really kind of requires, undergoing, regular audits. There's really a clear sort of separation of client and firm assets. We have bankruptcy protection. All of these things are really important aspects, which were always critical, in the digital asset space, but has become extremely more critical, obviously, in the wake of all of last week's activity. And so the ability to have that visibility, and that level of protection and kind of regulatory oversight from a Division of Banking who has been doing, reviews of trust companies for years and years and years. This adds a layer of protection that many other organizations don't have, and so this is a really important product, and offering that sFOX is able to offer its clients.
Yeah, no, that's super, super helpful to understand those key differences. I know a lot of people have been kind of just thinking that they need to take everything off of everything and they're not sure where to put their assets. I'm going to move on to Jack and then Daniel, but I want to start with Jack. What is sFOX doing to prevent risk? What is, if you want to share a bit on that, and then we'll move into Daniel highlighting what customers can do as well.
Yeah, thank you, Sarah. I think, John, you touched on a couple of key points already. As a licensed kind of trust entity, we're held to a certain standard already, right, in terms of the safety of client assets. And the nature of our model as an aggregator of liquidity also diversifies that counterparty risk, and by distributing kind of trading activity across different sources of liquidity. But in addition to that, we have taken steps to reduce exposure across venues and are reviewing counterparties we offer liquidity from, to maintain a very high standard of liquidity and safety on the platform. And at the end of the day, the number one priority for us is the safety of client assets. However, we still do need to ensure that we maintain the most liquid platform in crypto. That's a large part of our offering, especially in times of high volatility when your clients are looking to get in or out of their crypto positions. And so the team is working really diligently to support liquidity with the minimum kind of capital held with exchanges or trading with OTC market makers, just to further reduce that and mitigate that counterparty risk that any of our clients might face with a particular trade. And we're seeing this in the market microstructure as well. There is kind of lower overall liquidity across exchanges and OTC market makers. There are wider spreads kind of across the industry. So it's really important that for us internally, we stay diligent and take active steps to support the liquidity that and the partners that we're working with to provide liquidity for trading and client assets. But yeah, I think overall it's a matter of doing the most that we can to mitigate risk. But the nature of our model is already very diversified when it comes to risk from a counterparty's perspective, which our clients certainly benefit from, and we're able to maintain a highly stable and reliable trading environment as well.
Yeah, that's great. And I'm just looking at some of the questions coming in. We're going to have a full section. There is a quick question I just want to get answered because it pertains to what we've been discussing. And then I'll have Daniel share on what clients can do to protect themselves. There was a question on, did FTX not have a trust license? And if maybe John, if you want to take on, just clarifying that not all centralized exchanges have trust license, to actually totally different license. And maybe you want to just speak on that, as it is a little bit relevant to what we're chatting on.
No, they didn't, right? And so this was a key component, right? Was they were, FTX was registered, and sort of completely offshore in the Bahamas, kind of away from, any type of US, oversight or regulatory environment. FTX US, because that was sort of, their derivative book was, and that was really sort of derived from their acquisition of LedgerX. That really sort of had the CFTC oversight, because when you look at sort of trading derivatives, the CFTC sort of still has kind of clear oversight, really from a byproduct of the 2008 financial crisis and the Dodd-Frank Act. So short answer is that no, they were not, right? So they were kind of completely offshore, and this is what's kind of causing a lot of rift right now, is because there's been so much regulatory uncertainty in the US, specifically as it relates to spot trading of crypto, that many platforms were taking their organizational structure and bringing it offshore. And so this is really what's happening here. And so I think we're going to continue to want to have the regulators are going to continue to want to have some sort of line of sight, especially when you see something as major as this have such a widespread impact, especially on US-based customers.
Definitely. I do want to bring it back to Daniel, where Daniel, if you'd like to share what clients can do to protect themselves in the future, and then we'll move on to some of the questions that have been posted.
Yeah, sure thing. Thanks, Sarah. I think for both individuals and organizations that have multiple stakeholders involved, the biggest thing that you can do to try and protect yourself is to just have a plan for your custody, right? So the venue that you initially, purchased your assets on, or maybe you mined them, that's not going to necessarily be the best location for you for your long-term storage needs for your custody, right? So on our platform, I'm a big proponent of, understanding how to self-custody. So there are lots of great options for you as an individual to learn how to, self-custody, learn multi-sig, learn a lot of these empowering tools that you can do as an individual. Where we see a lot of our institutional and business and fund type clients interact with us and our Safe Trust company is people that need to have a little bit more robust custody offering. We have tools that allow you to work with your teammates to set certain rules about, who can access coins, what you can do in certain situations, set thresholds for the workflows that you want to design for your particular use case. But really just having a plan is where it all starts. I think we should really encourage people to ask questions and run through scenario analyses about, what happens to my coins if this happens. I hold a mixture of, crypto and USD. How does that play into the custody offering that you're able to provide? We've also seen a lot more people coming into having multiple custody providers. So instead of just choosing one, having a smaller subsection of 2 or even 3 custody providers to kind of give that cross section of what's available in the market has been really helpful for a lot of our clients recently. And then just harping back to the type of custodian that you're working with. There's a range of self-custody, working with a custody provider, and then there's custodians and qualified custodians, and those are official designations that are only available to certain types of entities, such as trusts that are regulated in various states. So from my perspective, the best thing that you can do is to plan out these things ahead of time, run scenario analyses, and then ask questions, because the worst thing for someone to find out is when it's too late. And we are always happy to answer questions. We jump on the phone with clients every day to talk about these types of things. So if you don't have a personal contact at sFOX, please reach out to me or somebody on my team, and we would love to help talk to you about that.
Yeah. Thank you. That's super helpful. And one thing I always like to boast about is that we have no bots at sFOX. Every email, even if it's support@sfox.com, which you can use today to ask questions, there's a real person behind that email. So you can ask any question and we'll make sure we hop on the phone and clarify. There's no such thing as a bad question. And that is the perfect segue into some of our Q&A. So I see we have quite a few questions. These questions, actually, there's a variety of, I would say, sections of questions. There's some that you guys have been asking about the legal process and proceedings. There are some that have to do with trust licenses. So I'm going to kind of be grouping the best I can. And of course, please feel free during this to continue submitting questions in the Q&A and letting us know who you would like to answer. But taking a look at the questions we have here, we've got a couple that I think can be answered together. One being, does the trust license automatically provide some level of bankruptcy protection? And then also another question, understanding the difference between trading on sFOX and custodying with sFOX and having access to the safe trust. So I think I'll let maybe John speak on, does the trust license automatically provide bankruptcy protection? What does this look like? And then Jack, if you want to kind of share on the difference between trading on sFOX and how our custody product works. Does that make sense? All right. So if that was confused, you got it.
Yep.
Right.
Yep. No. So what I would say first off is yes. The short answer is that becoming a customer of SAFE does provide bankruptcy protection, and so what I would encourage people to do in this space is if they are an already existing sFOX Inc. customer, I would encourage them to begin to look at the process of converting their account over to a SAFE, which is a subsidiary of sFOX, becoming a SAFE customer, and then that allows for you get still all of the benefits, the existing benefits of how you trade today from an sFOX perspective. Plus but you have the benefits of that. And then, I will maybe sort of turn it over to kind of talk about sort of some of the benefits of custody that sort of sits within that, which is, an added layer of protection, I would just sort of say in that space. So.
Yeah. And a question that came in right as you were speaking was, is it better to work with an exchange that owns the trust entity? I wouldn't necessarily say it like that, but I would say that I think I would rephrase that as, is it better to work with a exchange that has a trust license. I think that is something that is pretty clear, but John, if you just want to touch on that. This question also goes on to just, talk a little bit on, not being directly only an exchange to help with risk mitigation. So as you're mentioning, having a trust license backing is a big part of the risk mitigation here.
Yeah, I think, and again, it just sort of goes back to some of the points I was sort of alluding to before, the oversight, the regulatory kind of component of this. I think, one of the interesting things that we're sort of seeing kind of come out now in the FTX space was, if you look at sort of their, terms of service, which, ironically are still, available online, you can kind of see where they talk about where, we're not going to use, customer funds for, trading activity or anything like that. And, as everything kind of continues to unwind, we're starting to see that maybe that wasn't necessarily, very true and kind of what they did. And so as a trust company that has a regulator sort of overseeing what you're doing kind of day in, day out, right? That level of protection and that level of segregation is really quite critical, right? And it kind of comes down to, the avoidance of commingling of, client funds with, firm funds in that space.
Yeah. And we will be addressing, I know there's a lot of questions on specific around FTX and how to, file a claim, and I'll let Matt speak on that. But I do want to hop to Jack and get a little question answered on, the difference between trading on sFOX and the custody product, if you'd like to share on that.
Of course. No, I think, John covered it well just before this too. Being a client of the Safe Trust entity is kind of mostly an opt-in type of decision for our clients. But once a client has been kind of onboarded to the Safe Trust, there's really no change in the user experience that they're currently seeing with sFOX. It's just that their assets are custodied with the separate trust entity. And so you're getting all of the benefits of the sFOX platform, plus custodying your assets with the licensed trust entity.
Yeah, and then Sarah, just to tack onto that as well, with the FTX.com scenario, as a US person, you're really not supposed to be going offshore to their platform. But with the trust company, it kind of operates the opposite, to where, yes, we can support any state that we would otherwise support, but we can also support international clients coming onto the US platform through the trust company. So it can provide benefits globally too.
Yeah, no, that's super, super helpful. I'm going to transition. I know some of the questions have a lot to do with directly related to FTX. We have a question that came in specifically for Matthew. From past experience, how much time could it take for bankruptcy proceedings to be complete? And also, will this be an opportunity to write off deposits as a tax loss for 2022? The bankruptcy process is not complete within this year, which we imagine is unlikely.
Yes. I think that the FTX bankruptcy is going to be a lengthy one. As we talked about, there's sort of global components here, and even if the bankruptcy in the US is somehow not particularly lengthy, I think this process will go on for a couple of years. There's a lot to be. We don't even know what we don't know yet, right? It probably will take several months for the folks on the debtor side and the creditor committee to really wrap their heads around what the state of intercompany liabilities and customer liabilities and assets were. I think they're clearly in pursuit of the coin that was looted over the weekend, and as those who follow this space know, recovery rates on large scale thefts are better than you might think. And so, knock on wood, some of that will happen. Definitely no 2022 tax loss would be likely, because remember your investment, depending on whether your investment is classified as a security or not, or a deposit, there may be different stages. But I will tell you that saying that something that you want the professionals to prioritize a 2023 tax event. And there's a couple things. You can have a write-off. You can also have something called a theft loss deduction, right? So if this thing takes the bounce of the ball that there were criminal activities, the theft loss deduction is something that might come about, and that's a very powerful deduction because it's not limited as other typically investment loss deductions can only be applied against investment gains, right? A lot of people have not had many investment gains in 2022, even with the market rallying. You know, whether you own bonds or loans, chances are your portfolio is down versus the beginning of the year. But theft loss deductions have more broadly applicable uses. So I think that is something to flag for people like me and saying it's a priority. Is there a way to manage this process such that 2023 tax losses and deductions can be made available? Because I can tell you, I think the bankruptcy professional probably would not focus on 2023 for that. They anticipate this being a 2-year case, and you know, it would be 2024 would be the tax, the sort of the tax event year, unless people try to make it a priority to deliver otherwise.
What should we be doing? We cannot even log into our accounts anymore. How do we prove the assets, you know, the assets that were held there? So I think that's a good question. So
once again, it's about the company's books and records, right? And they have asked to sort of have some more time to publish their account records. We have had, in the 3 major crypto bankruptcies in the last 2 years, we've actually had customer account books and records be in pretty good shape. And once again, it's important not to say, well, because that's been the case in case X or Y, that it's going to be the case here. But we should hope that there will be good customer accounts. And if not, you know, people are going to have to, you know, source whatever the most recent documents are, and it could very be a nightmare. So I don't want to sugarcoat that. People certainly should be trying to find the most recent, you know, thing that is an authoritative statement of their balance, and you know, print that out, you know, save it to some offline storage or do whatever you need to do to make sure that you preserve that. But knock on wood, once again, the sort of the nominal customer accounts balance, how many Bitcoin, how many Ether, probably those records exist. So let's be hopeful.
Yeah, no, that's super helpful, and we will be sending out afterwards, you know, more information recapping what we spoke about today. I do want to possibly wrap up, depending on if more questions come through or not, but I do want to also touch on how has the market microstructure changed during these events, which I know, Jack, you might have some thoughts on this.
Yeah, I think I kind of you know, alluded to this earlier. You know, we've certainly seen reaction across exchanges and OTC market makers, you know, to these events. I think, you know, in all likelihood, you know, there was plenty of activity kind of across venues, right? So, you know, there was, you know, some exposure kind of across FTX and other platforms. So I think in general, you know, we have seen kind of, you know, across the board slightly lower liquidity and wider spreads from various sources of liquidity, just as a reaction to these events. And you know, certainly price has been very volatile as well. And so between kind of lower liquidity and wider spreads, you're seeing an even exaggerated level of volatility in the market. It seems like, you know, we're still kind of waiting to see how the dust settles and potential kind of rippling effects of these bankruptcies to determine, you know, if any other firms were greatly affected. But in general, it seems like right now everyone is, you know, just being a little bit more risk averse when it comes to providing liquidity. And you know, I think as a, you know, nature of our platform and kind of aggregating that, you know, we've certainly looked to kind of consolidate from, you know, the liquidity sources that are, you know, maintaining their stability and liquidity overall. But we've certainly seen a pretty drastic change in market microstructure since the FTX news.
Awesome. I think, we have quite a few other questions, and I know we want to be cognizant on time. So I'm just looking through if there's anything else that we might be able to provide the other panelists as well as yourself. This has been extremely insightful. It's been very much, we covered so many different topics in this hour session. So just wanted to thank you for your time coming on. I'll make sure that everybody has everyone's contacts. You'll be receiving a thank you email for attending. We really do appreciate your time coming into this webinar, and we are excited to continue these sessions. But thank you everyone so much for popping in today. We really do appreciate your time.
Thank you, everyone.
Thanks, everyone.